Hello, everybody, and welcome back to Making the Argument. Good news. The Federal Reserve has announced that inflation is pretty much dead.
We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Okay, and now let's go ahead and give you the Fed to English translation. Essentially, the Federal Reserve believes that inflation has essentially plateaued, and so therefore the high interest rates that they put on the economy in order to stabilize inflation can now start to gradually be removed as long as the economy is moving forward. And so now they're planning about 3 different rate cuts throughout the year. So what exactly does that mean? Well, you know all the stuff the Federal Reserve was doing before that kind of led to inflation? Well, now they think inflation's not so much of a problem, so they're going to go back to, doing the stuff that kind of led to inflation in the first place. And this kind of begs the question, if we all understand that this is problematic and maybe not something that we should be doing, why do we continue to do it? Well, we're going to answer several very important questions that will explain exactly why certain people seem to like this cycle, because lo and behold, not everyone is devastated by it. So we're going to discuss, what was it like before the Fed? Why did we actually build a Fed in the first place, and what does it do? And then we're going to talk about what these actions do and answer the important question of, is this actually a form of election interference? All of that and more coming up on this episode of Making the Argument, brought to you by Good Ranchers. All right, as always, I am your host, Nick Freitas. With us remotely is my beautiful bride, Tina, Queen of the Bees.
Hello, everyone.
And then, of course, we have our political prognosticator, resident historian, and mostly benevolent warlord in training, Master Hines. How you doing, Christian?
I bought one whole Bitcoin this week.
Whoa, that's kind of wait. Did you buy one whole Bitcoin in one foul swoop, or did your total assets equal one Bitcoin?
No, I bought one whole Bitcoin.
Dang. Well, let's rob this guy. Hey, ladies. Guy owns a Bitcoin. And if you know the price of Bitcoin right now, holy crap. All right. And then Hamilton, our producer of producers, the good Hamilton, the one that doesn't like central banking, which is amazing because this would be a great conversation for him to be in, since it's pretty much all about central banking today. But listen, here's what we actually want to do. Oh, sorry, I should say he's not going to be with us. Here's what I want to do. I want to talk a little bit about, how did we get to this point? Because the Federal Reserve announcing that inflation has essentially been tackled leads a lot of people to believe, oh, okay, so prices are going to start going down, right? No. In fact, if anything, they're probably going to start gradually going up again, albeit a little bit slower than it was, 2, 3, 4 years ago. So we need to kind of explain, why do we keep doing this? This is just driving people nuts. And a lot of politicians have their favorite answer. And the favorite answer of people like Senator Elizabeth Warren is, well, this is because greedy businesses, right, have just decided that they're just profit focused and they don't care about the laborer and they don't care about the consumer. But this kind of begs the question. All right. So Liz, if you will, if businesses are always the horrible, greedy institutions that you think they are, did they just get more greedy all of a sudden? Are they deciding to get greedy again real quick? And are we just going to let them get away with it? No, the answer is that businesses, like everybody else, are responding to certain things that are taking place in the economy. And one of the major things that is pushing the things that are taking place in the economy is monetary policy. It's the things that the government is doing, Senator Warren, things that you are in fact encouraging, things that you are in fact legislating. And so it's a little bit disingenuous to claim that everybody else is the bad guy when ultimately a lot of what they're doing is just a mere response to what the federal government and the Federal Reserve is doing. So let's go into this first question here. And that is, what was why do we have a Federal Reserve? And before we can answer that, we have to actually, investigate as to why did we think it was necessary to have a Federal Reserve? Now, if you go back to the very, early, the very beginning of the United States, you had this debate that was going on between Alexander Hamilton and Thomas Jefferson. And a lot of that was about the first American bank, the first, the centralized banking system that we had. And what was going on was Alexander Hamilton thought, for a couple of reasons, he thought that we needed a central bank. A lot of it was influenced by looking at the Bank of England. A lot of it was influenced by the fact that he thought it would unite the states if the federal government assumed all of the states' various war debts for fighting the revolution. And he also looked at it as kind of a necessary and proper things in order for the federal government to be able to take money and then to be able to distribute money. So there was a lot of reasons why Alexander Hamilton wanted the central bank. But one of the things that you need to understand right off the bat is that Alexander Hamilton was also somebody that wanted an incredibly powerful central government. Right? Alexander Hamilton didn't want a president that we would elect every 4 years. Alexander Hamilton actually wanted something of an elected monarchy and someone that would serve for a life term. Right? He wanted a very powerful federal government to kind of pull strings. He was a big fan of tariffs. He was a big fan of trying to use the government in order to influence industry. So there's a reason why we call Nick Hamilton here as our producer, the good Hamilton, the one that doesn't like central banking. It really started there. You had the first bank, then you had the second bank that actually came about under the Madison administration. James Madison had previously opposed the national bank, but due to conditions with the War of 1812 and the difficulty of being able to finance that war, and keep that in mind because that's going to heavily influence why we have a central bank. Turns out it's not just to protect the money supply or to, achieve full employment. Turns out that one of the things central banking has been really good for is allowing the federal government a quick way to be able to raise money and spend it. And lo and behold, one of the things federal governments like to spend money on is wars, right? But Andrew Jackson managed to get rid of the bank, right? That was one of his primary things that he campaigned on, was getting rid of both the national debt and the bank. And he did both. He did both within his time. And Andrew Jackson did a lot of horrible things, but these were a couple positive things that he managed to do. Now, does that mean we automatically went into this era of just free banking all over the place? No. There's an article I want to bring up, not this one, but there's another one that we talk about on why did the federal government, why did the bank come about in the first place? And if you look at some of the reasons behind it, it had to do with something called the national banking system that we had before, right? And the national banking system was something that was set up in 1863 and survived till about 1913 until we went into the Federal Reserve model. And again, we had kind of more of a free banking system after Andrew Jackson got rid of the bank. So why in 1863 did we start to set up this national banking system? I wonder if it had anything to do with things that were going on surrounding the Civil War. And what happened was there was three things that took place during the national banking system, three major regulations that took place. The first one was there was the limits on the ability of banks to operate branches, right? So in many cases, you might have a bank and they were only allowed to have one office. They couldn't set up multiple branches. You had minimum reserve requirements, right? And that's because we live in a fractional reserve banking. So when you deposit that $100 into the bank, all 100 of it doesn't go back into the vault, right? They have to keep maybe 10% of that. So $10 go in the vault to be set as a reserve. And then the rest of that money is then loaned out, and the bank makes money by getting interest on the money that they're able to loan out, right? And as long as the goal is to have enough money in reserve, so when you go to the bank and you request your money, there's enough money to give to you for those purposes or those transactions, but ultimately the bank makes money off of loaning your money to other people. And then the third component was requirements that banks that produce currency buy up certain bonds or other financial assets as collateral. Now, what does that mean in English, right? Here's what I want to say here. This part is interesting. The bond collateral requirements were a problem. Before the Civil War, they often served as a form of crony capitalism, as some states required that banks buy the bonds of railroads and other nominally private enterprises. That's another way of saying like public-private ventures, right? Instead of or in addition to government bonds to serve as collateral. In the National Banking Service, federally chartered banks were required to buy federal government bonds as a way of financing the Civil War. Hey, there it is again. So basically what the government does is like, okay, we will allow you to charter this bank, but guess what you got to buy? Federal bonds. And what were those federal bonds used for? To fight the Civil War. Now, again, we can argue all day long about whether or not it's the necessity of governments to be able to fight wars. All right, but understand that the government was heavily intervening into the banking system, not to protect your assets, but to be able to ensure that when the government wanted money, it could force these banks or these nominally private banks to be able to finance it by buying government bonds. Now, here's where this kind of came down to a head. And we can go back to that other article. In 1893 and again in 1907, you had these crisis that took place on Wall Street and with various banks. And it got so bad that private investors like JP Morgan, right, these private bankers that had a lot of diversified assets, that had a lot of cash on hand, they actually had to intervene in order to prop up and save certain banks so the people that had invested through those banks didn't lose everything. Now, one of the things that progressive politicians at that time said was that, oh, well, don't hold up JP Morgan as being a hero for saving the banking industry because he made a lot of shady deals in that process and they bought up a lot of assets that were undervalued at the time. And so he made a lot of money throughout this process. And sure, you can make that argument, but you could also make the argument that both of these crises, whether it was in 1893 or 1907, actually got saved by the private sector making decisions, buying up troubled assets, and actually making some of the investors, or at least the depositors, whole during that process without the government having to intervene and actually, use a bunch of tax dollars to bail out banks. So even though there was problems with the system, it's funny how the thing they hold up is this is really a problem and Wall Street has too much power, right? Sure, make that argument, but they were still putting their own money at risk in order to save these troubled assets. All right. Now, how does this lead us to the Federal Reserve? Well, essentially what ended up happening was that you had, there's a book called The Creature of Jekyll Island. You had a bunch of high-level financiers, of which JP Morgan and several others were a key part of this. They visited Jekyll Island, and it was kind of a secretive meeting, and they came up with this notion of the Federal Reserve Bank. And again, a lot of what they wanted to model was off of the Bank of England. The Bank of England was, no pun intended, kind of the gold standard for centralized banks. And so when they met, the idea is to try to mimic some of that, but they wanted a lot more private sector autonomy for the bank, whereas Woodrow Wilson and the progressive politicians, they wanted more federal control over the bank. And when we ended up was with this kind of, for lack of a better term, negotiation, where they end up with a Federal Reserve Bank that is not totally controlled by the federal government, but the federal government has some limited oversight, which is to say that they can actually, the president appoints the Federal Reserve chairman and the various positions within the Federal Reserve banks all throughout the country. So that's just kind of a very, very quick, and anybody that is really dug into this is going to be throwing things at me going, you didn't mention this and you didn't mention this. My purpose here is not to give you an exhaustive list of the various things that happened before the Federal Reserve went into place. It's merely to point out that the United States was able to exist, right? Investment was able to take place, and all of this before we had a Federal Reserve. Right. So this idea that we would never be able to function or even thrive as a society without some Federal Reserve, system manipulating currency is just, it's incorrect. It's verifiably false. And in fact, later on in the episode, we're going to talk a little bit about, okay, how has it worked out for us? Okay, so, but first, let's talk a little bit about the Federal Reserve and why people that kind of get a little bit too conspiratorial on this, right? Again, like I said, there's people that think that, again, this is just a cabal of little bankers that did this. And here's all I'll tell you. A lot of times, some of the worst things that governments do are not in response to a couple of people pulling strings. It's in results to genuine concerns over insecurity within a particular system or instances where the system hasn't behaved the way they wanted, and then trying to come up with solutions to that, and then copying solutions that have been used in other places, thinking that, well, it's kind of worked for them, so it'll kind of work for us, right? And that's what you saw in this. It's not that different organizations didn't recognize that there could be problems with it, but ultimately they were trying to address the concerns with these banking crises, with runs on the banks, with inflationary issues, and they thought the Federal Reserve would be a great way to, again, potentially do this. So let's look at what exactly is the Federal Reserve System. And this is critical because I think a lot of people think that the Federal Reserve is something that Congress votes on, or that the chairman of the Federal Reserve is a position within the president's cabinet. And that's just not the case, right? The Federal Reserve System, and we're just taking this right off of some of the articles that we have here. The Federal Reserve System is composed of several layers. It is governed by the presidentially appointed Board of Governors, or the Federal Reserve Board, right? Again, this is the part where the government has some say in this. And then 12 regional Federal Reserve banks located in cities throughout the nation who regulate and oversee privately owned commercial banks. Nationally chartered commercial banks are required to hold stock in and can elect some board members of the Federal Reserve Bank of their region. The federal government sets the salaries of the board's 7 governors. I'm going to tell you right now, most of the people in there probably don't care what their federal salary is, right? And it receives all the system's annual profits after dividends on members' bank capital investments are paid. The purpose, all right, the primary declared motivation for creating the Federal Reserve System was to address banking panics. So again, you had 1893. You had 1907. These are pretty significant. There was a lot of depositors that thought they were going to lose all their money because their banks had made bad investments and they were going to go out of business, right? What happened in those cases? You had other private investors, other private banks look at the assets that were causing the problems and decide to buy assets at discounted rates, and they essentially averted the crisis, right? Now, does that mean there weren't depositors or investors that lost money? No, they did. Did that mean that there weren't other assets that completely lost all value and went bankrupt? No, they did, right? But there was a mechanism prior to the Fed for dealing with it, but they didn't think it was stable enough. So the other purposes stated in the Federal Reserve Act, such as to furnish an elastic currency to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. Now, I will say this. If you ask people what is the job of the Federal Reserve, they generally give you 2 answers. One is to basically protect or manage inflation. I don't even say protect against inflation. It's to manage inflation. And then there's another purpose, which doesn't make a lot of sense if you think about it, but is to work toward ensuring full employment, right? And I mean, Christian, you were...
The dual mandate is technically, I believe, listed as stable prices and full employment, which is very funny because if you're only using monetary policy, which is the only thing the Federal Reserve can do, they can't print houses and print jobs, right? If you're only using monetary policy and fiscal policy, if you combine, them coordinating with Congress, right? If you're only using monetary policy and somewhat fiscal policy to achieve those 2 ends, you literally cannot get one without destroying the other. If you're
Explain that.
So stable prices, that implies no inflation or very, very minimal inflation. Technically, all of these people operate on some quasi-Keynesian idea of the world, and so the deflation is like, doomsday to them, right? Yeah. And so what they really want is either stable prices, not falling prices, or slow inflation over time, right? That's what stable prices is. Full employment is exactly what it says on the tin, right? It's maximum employment. Everybody has a job. Well, the only way that you can get everybody having a job is either you increase the number of goods and services that are in production so that way everybody who has a job can actually buy those goods and services. Elsewise, the money that they're being paid will be chasing after too few goods and services, which will drive the price up. Right? So you actually need a productivity increase in order for you to not have inflation take place when you have a hypothetical full employment. And for anybody asking, the only way you can actually have full employment is if you invade another country and start a war. If you draft everybody, Hitler had full employment when he invaded Poland and the Soviet Union. Yeah, that's the only way that you can actually have full employment. Usually, you'll always have some level of unemployment.
Again, theoretically, if you had a max productivity, could you arrive at that? Sure. The problem is that in most economies, you're going to have fluctuations. You're going to have, uptimes, downtimes, et cetera, whatever it is. But this idea that you're going to achieve, if you put that as a mandate, your mandate is full employment. Okay, well, that's essentially impossible, especially with the mechanisms that you've given the Federal Reserve to do it. So, for instance, if you tell the chief executive, if a president said, my mandate is full employment, and then as soon as he gets in office, he starts a war, does a draft, and drafts everybody. Okay, great. You now have full employment. But nobody's better off as a result of that because obviously you've taken people out of productive sectors of the economy producing goods and services that we all want in order to go blow things up or shoot people, right? So that's not a...
And the stable prices, during the Great Depression, there were either stable or falling prices. The Great Depression was a mass deflationary credit crunch where prices were collapsing because there was no credit. and interest, everybody went bankrupt. Everybody who had debts went bust, right? And so the Great Depression is a massive credit crunch. Well, you had stable or falling prices during the Great Depression. Everything was dirt cheap, but nobody had a job, right? And so you see this balance here where unemployment was through the roof during the Great Depression, but everything was dirt cheap. And so again, if you're using only monetary, and I stress this because you can have stable prices and maybe not full employment, because that is a Keynesian dream, but you could have low employment and stable prices if you have a productivity boom, if you have more goods and services being produced and they're being produced faster and cheaper than ever before, and the quality isn't declining as a result. And so those are things that are deflationary. Like a good example of this is automation. The Industrial Revolution, the ability to mass produce things like furniture and stuff like that.
Yeah.
Well, that drives down the price of buying. It used to be 300 years ago, you needed to be wealthy to buy an ornate chair from somebody. You needed, months worth of salaries to do that. Well, nowadays, anybody can go to any, department store and buy a chair for like $100 or a couple $100. And the reason why is because we can mass produce those things. So things like, in the modern sense, things like automation, AI, robotics, these are things that are going to be deflationary over time as they become more and more adopted. And so I just stress that because monetary policy alone, you cannot achieve both of these things that are the Federal Reserve's dual mandate. You just can't.
Well, and again, this is also one of those problems when people think about currency, right? If you think about wealth in terms of the amount of dollars you have, that's ultimately not the best way to think about it. Those dollars only have value if they have purchasing power, if they can actually buy the goods and services which actually make you wealthy. And so the problem with the Federal Reserve and the way it's managing monetary policy is that it's generally using inflation in order to either try to kickstart the economy, and then it will use higher interest rates in order to slow down the economy. And it creates this impression that the way that you manage an economy effectively is through this sort of arbitrary monetary, or not arbitrary, but monetary policy, when in reality, a strong economy is one that is based off of productivity, right? It's not based off of like this Keynesian, this caricature of Keynes, but somewhat accurate of like, this is just about aggregate spending. We just need more people spending more money, and that no, you need higher productivity of the goods and services that people actually want to buy, because those industries are providing the jobs, which provide the goods and services, which provide the salaries, which provide the economic exchange which takes place. But if you're saying, well, I'm going to manipulate that process by throwing more money at something, well, again, you haven't increased productivity by printing more dollars. You've just made the value of each individual dollar go down. So even like people say like, oh my gosh, that laptop or that chair or that steak is so expensive. No, the value of that steak has not gone up. The value of your dollar has gone down. It requires more dollars to buy the same steak. And we're going to actually explain why this is so problematic later on. But here's what I want to get to here. So we've kind of explained what was going on before the Fed. Now we've kind of explained why the Fed was created and what the Fed's job is supposed to be. There's one other thing I want to talk about, and then we're going to go into like, okay, how has this worked out? Has the Fed made it? Are we better off now with the Fed than we were without the Fed? And in order to be intellectually honest here, I want to point out this, because it's not just the Fed, it's also the way that the federal government has moved away from sound money. And so when we say sound money, what do we mean? Well, we get caricatured as, oh, you think everyone should be walking around with little bags of gold or silver coins or whatever else. No, you can have paper money. The difference is that when you have paper money and it is backed by something, usually a commodity or what we call a commodity-backed asset, like gold, like silver, what it does is it prevents politicians from being able to just arbitrarily print out more money whenever they feel like it. And then they can devalue that individual piece of paper. But if it's backed by gold, then what it is that you have the ability to say that this paper is worth this much gold or this much silver, or whatever it is, right? You don't need to get hung up on gold. But what that does is it takes away the government's ability to just simply print more of the same dollars because it's legally now backed to something. Well, what's important to understand is that beginning under FDR, when he made it illegal for people to own gold, that created a problem where FDR started arbitrarily setting the price of gold based off of his lucky numbers. Again, whenever I say that, people think that can't be true. You can go read some of FDR's biggest sycophantic biographers out there, people that just loved FDR, and they admit that he was literally trying to set the price of gold based off of lucky numbers, right? Just absurdity. But then you fast forward to Nixon. So we were working office. So he started to kind of remove, really started to manipulate essentially the gold market in the United States and commodity-backed dollars. And we started to move in this exchange rate system that was largely influenced by Keynes and others. And what it did was we weren't a totally gold-backed system anymore, but we were a system to which there was still checks and balances in place to where one government participating in the system couldn't just arbitrarily print more money. We completely went off that under the Nixon administration. So the bottom line is, through bad fiscal policy and bad monetary policy, we found ourselves in a situation where Nixon was terrified that essentially the economy was going to collapse. And he felt that the only way that he could actually deal with that problem was by completely removing us from any vestige of the gold standard. And we went to a straight fiat currency, a straight paper money standard. What does that mean? It means that the dollar that you have, right, is called a Federal Reserve note, right? So it's a part of the Federal Reserve system. What is it backed by? The full faith and credit of the United States government. It's not backed by gold. It's not backed by silver. It's not backed by any sort of national or international law. The only thing that's backed by is the full faith and credit of the United States government, which is to say that the federal government will allow you to pay your taxes with Federal Reserve notes. And since everybody has to pay taxes, and since the government will allow you to pay it with Federal Reserve notes, therefore that Federal Reserve note has some sort of value, at least for the purposes of paying taxes, and therefore it can still be used as a medium of exchange within the United States. But if you think it is backed by anything of like genuine value, it isn't. And what this does is it gives the federal government an enormous amount of power to manipulate currency, because now there's essentially nothing holding them back except for the fact that it's devastating the economy. The problem is politicians have gotten really, really good at convincing people that it's not them causing the bad economy. It's greedy business owners, or it's some foreign entity, or it's some, natural disaster, whatever it is, right? It's always somebody else's fault except for themselves. And so they constantly engage in this kind of inflationary monetary policy. And here's what's really important to remember is that, again, true value, please understand this, true value is not found in the individual dollar. It's found in the good and services that that dollar can buy. And there's no better good that you can buy than Good Ranchers. Right? That's right. Because that steak that you get from Good Ranchers delivered to your door has actual tangible value, baby. When I'm eating a steak, I'm happy. I'm a happy person. And if you go to goodranchers.com right now and you put in promo code Nick and you sign up for one of the subscriptions, guess what you're going to get? You're going to get free chicken wings. That's 2 pounds of chicken wings with each order for a full year, right? As we start to move into game season, right? We start to move into like baseball season's coming up. We're going to be preparing for football on the other side of the summer, right? You're going to be getting free chicken wings, 2 pounds of chicken wings with each order the entire year, right? So sign up right now, goodranchers.com, promo code Nick, in order to get the sort of meat that doesn't have a bunch of mRNA vaccines in it. When they say this beef was raised in America, it actually was, unlike some of the stuff that you get at the grocery store. Goodranchers.com, promo code Nick. Go ahead and sign up for that deal. All right. So with all those explanations about
I support
Fed,
the steak standard.
Yeah. I want steak. I want prime rib backed dollars.
In Argentina, fun fact, Malay actually legalized allowing you to be paid in things like eggs or food and stuff like that because they hold their value longer than the Argentinian peso. And that is kind of a segue to get us to where we're heading.
Yeah.
Because
let's look at this first one I want to look at actually has to do with the value of your dollar over time.
Oh, okay.
And we've got a couple charts here that are really important. So now that we've talked about why did this happen, what happened, and now are we better off? One of the most important things that you can look at, because again, we've talked about what is the Fed's responsibility, right? Stable prices, full employment. All right. So let's look at the purchasing power of your U.S. dollar over time. So if you go all the way back, it says the Federal Reserve Act creates a central bank with the ability to manage the country's money supply.
And that's in 1913.
That's in 1913. So what we're looking at right now is the picture of a dollar, all right? And we're showing the overall purchasing power of your individual dollar. What we find is that when the Federal Reserve is first established, right, you've got a, for lack of a better term, 100% purchasing power of your dollar, right? It's the full value of your dollar. And then you go all the way to 2020, and here's what you find. The U.S. money supply grew by $3.8 trillion in 2020, equal to 20% of all dollars ever created. And essentially, here's what it comes down to. Your dollar now is worth a fraction of what that same dollar was in 1900. So the same dollar the same dollar that you have in your pocket right now, right, would be worth $25 all the way back to when the Federal Reserve was put into place.
It actually would be higher than that because this chart ends in 2020.
Yeah.
Anybody want to take a guess who's listening? What happened in 2021, 2022, 2023?
So keep that in mind. Like the Federal Reserve, what was one of its primary missions? Stable prices. But the overall purchasing power, the overall value of your dollar has shrunk 25 times since the Federal Reserve went into place, right? Not 25%, right? It was worth 25 times more than it is right now, back when the Federal Reserve first went into play. Here's another thing that I want to look at, and this has to do with overall prices. And this time we took it all the way back to 1800 because here's what we wanted to show. We didn't want to cook the books here and just show you, when the Federal Reserve went into place, what was it like before that? Obviously, it was probably really bad, right? You probably had all this price fluctuation based off of inflation and everything else. Nope. When you look at U.S. price levels, 1800 to 1999, okay? This just goes to 1999. We're not even going to modern day. And as you look at this graph, for all of our audio listeners, what you end up finding is that you have amazing stability, amazing price stability for almost the entire time, even to certain points, all right? So you have it all the way to like 1910, right? Then it shoots up a little bit in 1920, right? Because we've also got wars going on and things of that nature. You got World War I ending. Then you have the Great Depression, but it starts to from 1940 up, it starts to gradually increase. And then all of a sudden when you hit 1970, it starts to skyrocket, right? So basically over time, if you imagine a line that's like kind of moving up, moving down over time, maybe it's gradually increasing, but then it goes back down and levels out. And then all of a sudden it starts to steadily increase, but at a fairly slow pace. But then in 1970, all of a sudden it just goes shooting up and you see this like hockey stick effect on the chart. So what happened? This combination of the Federal Reserve, because again, like I said before, you can't blame it all on the Federal Reserve. But what ends up happening?
You have the same thing with $100 adjusted for inflation going back to 1635. So obviously they're adjusting for things like the pound back then, right? But you see the same thing from 1635 all the way until really the end of World War II. The dollar, and before that the pound, same thing adjusted for inflation. There was minimal inflation for 200-300 years. Mm-hmm. And then it starts to grow between the end of World War II and 1971. And then after 1971, something incredible happens, right? It like you said, it turns into a hockey stick and it just goes right up and to the right.
Yeah.
And there's this fantastic website that I recommend everybody take a look at when they're done listening to this podcast. And it's called WTFhappenedin1971.com. There's so many charts here, I can't even go through them all. I can't even go
to the
through
first one, because the first one shows something that is really important. This goes to the kind of the sound money component that we're looking at, because one of the things that you hear a lot of politicians talk about is wealth has gone up, productivity has gone up, but wages have remained flat. Now, there's a couple of reasons for this. It's not as if, first of all, you do need to take into account that when you look at overall compensation, right? There's a lot of ways that workers get compensated now that they didn't necessarily get compensated before, right? There's healthcare benefits. There's other requirements that the federal government or state governments require people to include. But the biggest change that took place is that when we removed all vestiges of the gold standard, and now all of a sudden you have this situation where the federal government could print more money in order to subsidize its spending habits, and you had the Federal Reserve that was willing to, that was a part of that function in the money printing process and the interest rate process, and now all of a sudden it was completely detached from any vestige of sound money, now you have a federal government that essentially has carte blanche to be able to do this. So what ends up happening is it just that businessmen got super greedy overnight, that they weren't taxed enough? No. What ended up happening is that wealth was now being created, and I hate to use that term, but monetary wealth was being created by bad fiscal and monetary policy. And not everyone is impacted the same way by inflationary monetary policy. So for instance, if you're an investor, if you're someone that has assets that it's very easy for you to move around into things that are more inflation proof, or you're somebody that can invest in the sort of assets which actually appreciate in value during an inflationary economy, well, then you're able to move your stuff around. You simply move it. When that new money is printed, does it go out to everybody? Is it distributed to everybody equally at the same time? No, it's funneled through what? Banks attached to the Federal Reserve System. They have first scratch at the government, and the bank system, as a part of this system, are the ones that have first access to that money. So if I print $3 trillion in a relatively short period of time, are we going to feel the inflation right away? No. We're going to feel it when those dollars start to hit the market and start competing for goods and services. Because all of a sudden, it's not like we have more money because we've been so productive that we've created so many more goods and services that now all of a sudden we have more jobs and more money flowing. That's not what's going on here. There's just more dollars competing for the same number of services. So the value of what that is didn't go up. The value of your dollar went down, and now you're poorer. So maybe you got a 3% raise, but if inflation's 8%, you essentially got a pay cut. Not because your boss was a bad guy, not because your employer is just a horrible human being, but because the government engaged in inflationary monetary policy. Because guess what? The vast majority of employers within the United States are actually small business owners. Small business owners are not going around manipulating their stock portfolios every time inflationary monetary policy takes place. They're also getting hit by this as well. They're having to increase prices on goods and services because they can't afford the raw materials to create the things that they're actually producing as manufactured products to get to you. All right, so who is benefiting? Again, politicians that now have more dollars to spend without taxing it or borrowing it, right? The banks connected within the Federal Reserve System that get first crack at that money, right? And the high-level investors that understand exactly how this monetary policy works. And listen, before you look at the millionaires and billionaires that are moving around these stock portfolios, what are they supposed to do? They don't have control over whether or not the Federal Reserve decides to lower interest rates. They don't have control on whether or not the Treasury and the Federal Reserve working in conjunction with one another print out trillions of dollars. They don't control that process. They just have the means to adjust their investment portfolio based off of that process taking place. And here's the part where it gets incredibly frustrating. The same politicians, I'm looking at you, Senator Elizabeth Warren, who screamed the loudest about tax the rich and stick up for the little guy. She was the same one going out there encouraging the Federal Reserve to lower interest rates in the midst of an inflationary economy. And then she says, no. Inflation's not because the federal government is just printing out more dollars. No. Inflation is because of greedy business owners. Liz, I got news for you. The greedy business owners, the ones that can, are simply adjusting to what you're doing at the federal level. Now, here's the argument that comes back, right? They'll say, okay, well, Nick, but they're experiencing record profits. Well, they're experiencing a record high number of dollars because there's more dollars in circulation. And so part of the question is why does that translate to higher salaries or hiring more people? Well, let me ask you something, Senator Warren. Let me ask you something to every politician out there. Have you as a federal government or as state governments, have you made it easier to hire people or more difficult? Have you put less requirements on hiring people or more requirements on hiring people? I sat there a month and a half ago as I watched my colleagues in the General Assembly all vote unanimously, except for, on their side, voted unanimously for a bill that if a local coffee shop owner was interviewing a prospective employee and asked them the question, what did you get paid at your last job? They could be sued for up to $11,000 for the first offense. They could be sued for $11,000 for the first offense 2 years after it happened. So let me ask you something. In the sort of environment where taxes, regulations, and monetary policy are creating scenarios where now your employees are not just your greatest asset, they're now also potentially your greatest liability. Because the coffee machine isn't going to sue you. The kiosk isn't going to sue you. The tables and chairs aren't going to sue you. The infrastructure isn't going to sue you. But the employees can. So if you create a scenario where you've caused inflation through monetary policy, you've fueled that inflation through bad fiscal policy, and then at the same time, you've told businesses across the country, we're going to punish you if you don't run your businesses the way we want. If we don't think you're taking care of your employees the way we think you should, we're going to punish you. Does that incentivize them to invest the dollars that they currently have in more employees? If you're a small business and you're hanging on by a thread because you have no idea what the next rule, regulation, tax, fee, fine, you have no idea what the next inflationary wave might potentially do to your business, are you going to invest in what is potentially the most expensive and greatest liability in your business, which could be people? Are you going to do that? No. You are going to try to come up with as much infrastructure as you can to make sure that your business can survive, and then you're going to hold on to assets and potentially diversify into something that might be inflationary proof because you have no idea what the idiots in Washington, D.C. or your state governments are going to do because you're the one that has to live at the business end of every stupid idea they have. And then they get to get up there as the grandiose demagogue and tell you you should be doing it better. Why aren't you doing a better job of predicting the stupid things we're going to make you do? It is absolutely asinine.
That I just wanted to chime in one little thing, and that's where a lot of these people, whereas automating would have been too expensive and cost prohibitive at a point, the government has imposed so many regulations and so many requirements and made employees so expensive to maintain that now the cost is so offset that they're going to automate because at least if you automate, you don't need to worry about workman's comp. You don't need to worry about all the extra taxes you have to pay. A lot of people don't realize that when you have employees, a lot of the taxes that you pay from your paycheck, your employer is matching those and paying that to the federal government and to the state. And so all of that is eliminated when they automate. And so it may be really expensive to automate at first, but over the long term, because of the way things are going, automation is basically taking over the job market. And so you're hurting employment even more when you're increasing these things artificially and adding all these regulations. And businesses don't just want to, throw out their employees and automate. It's just they're being forced to. And so in the process, you get worse service, you get less employment. And so now what the federal government does is they trade a wage that everybody was upset with a much higher unemployment. A lot of these people aren't able to get employed now, and we're having robots or whatever do the job, or the job's just going away, period.
And now we have a situation too where they'll say, well, okay, why do we have if there's more jobs than people are looking for, why they're doing those jobs. And again, the meme version of this is, it's because businesses aren't taking care of their employees the way that they should. And it's like, look, I'm sure that is true of some businesses. I'm absolutely positive that's true of some businesses. You know what I'm also sure of? Some employees are not actually worth what they're getting paid. I'm sure of both of those things because the bell curve works in the labor market just like it works in the employer market. Right? There's
Right.
great employers, there's bad employers, and there's in-between employers. There's great employees, there's bad employees, and there's in-between employees. The difference is the market allows for employer and employee to be able to work out the conditions of the employment until the government constantly intervenes. But here's what I want to do now. Because again, we're kind of demonstrating here how this combination of sound money in conjunction with Federal Reserve monetary policy is creating these conditions.
You mean fiat money?
Fiat
not
money.
Sound.
Sorry. Well, getting rid of sound money.
Yeah.
Christian, you've got a lot more charts on this that really hammers this point home. And this is important for people to understand, because we don't want you to think that we're just casually cherry picking statistics. It's like we're looking at this across the board. And the reason why all of these things are happening, and the reason why we're going to be able to probably accurately predict, which is the next thing we're going to talk about, some of the things that will happen, is because we've got literally hundreds of years, arguably thousands of years of history on what happens when governments do this. But the reason why it's important for us to stress is because, again, when the layman is looking at this, thinking, then why do it? Because not everybody is equally affected or even adversely affected by these policies. Politicians actually find them hugely beneficial for the consolidation of their own power. And they may think that they're actually doing it for good reasons. Well, once I have this power, I'm going to take care of these people. The problem is that they're operating off of absolute arrogance, as if they can somehow micromanage an economy consisting of hundreds of millions of people just in the United States and billions worldwide engaging in exchange. But let's go over some of the other consequences of this.
So this chart radicalized me. Not going to lie, Nick.
Yeah.
This chart is actually from the Federal Reserve. There's this thing called FRED, which is Federal Reserve Economic Data. Highly recommend that people take a look at this if they enjoy numbers and statistics. And what this shows is it goes back to 1989, I believe. And so it doesn't even go back to 1971 when we permanently left the gold standard.
Yeah.
But what this shows is the amount of wealth of the bottom 50% of net worth of the United States. So again, the bottom half of all Americans, which is 150 million plus people, compared to the net worth of the top, not 1%, 0.1%.
Yeah.
So this is 99.9th percentile, not 99th percentile, right? 99.9th percentile to 100th percentile. This is a very small number of people. These aren't millionaires. These aren't even billionaires. These are like multi-billionaires, right? And there's this other chart in here. There's a third line in here that shows the M2 money supply. And this one's actually very important because it's going to lead us to some other discussions here in a minute.
Explain M2 money supply just so everyone understands.
M2 money supply is basically the amount of money that exists. And when I say money that exists, I mean like not just in circulation, like physical dollars, but for example, the money in your bank account constitutes that. Money in your bank account is not yet in physical dollars unless you go to the bank and you actually get it, right? But the M2 money supply is basically how many dollars are there, right? And what you see over time is a very, very strong correlation between the amount of money that is being printed, being injected into the economy, and the net worth of the ultra wealthy.
Yeah.
Again, the top 0.1% of the population. And when you look at the bottom 50%, though, well, these people got ruined. Mm-hmm. They got absolutely devastated. When you go back to 1990, the gap between the bottom 50%, and socialists actually talk about this a lot, and it's the one thing that they're right on when it comes to identifying the problem, and then they propose the exact same type of solutions that created the problem in the first place. It's actually a very common pattern with socialists.
Well, and I would argue that they're right at pointing out that there is a problem, but they've even misdiagnosed why the problem has taken place.
Yes,
they will point at this chart and say, capitalism. Like, okay, well, I'm looking at this chart and okay, before 1995, where this really started to separate, we still had capitalism. So what was it? Because it wasn't capitalism.
It was the money printing.
It was the money
it's
printing.
the money supply. You look at the strong correlation between the amount of dollars that have basically been printed into existence by the Federal Reserve over time, or by deficit spending relentlessly by Congress, right? And so that's creating new money out of thin air through things like debt monetization. The net worth of the people that have the most assets naturally, the top 1% of society, has tracked pretty closely with the amount of money in existence. And so in a way, actually, you could actually argue that the ultra wealthy actually haven't been getting wealthier. They've just been treading water with the amount of money in circulation. Yeah. What's actually been happening is the bottom 50% have been getting substantially poorer relative to the amount of money in existence. And so the socialist actually has this flipped around. Somebody like Elizabeth Warren or Bernie Sanders would say Elon Musk or Jeff Bezos or whatever these people are, they've just been fleecing the American people. No, the Federal Reserve and Congress have been fleecing the American people. It's just that a very small number of people have been keeping up with the fleecing, and most people have not been keeping up with it. So why do I bring this up? because this M2 money supply thing is going to lead us down a rabbit trail that is going to end in some existential dread. I'm going to give you the black pill, and maybe Nick will give you the white pill here. So here's a different chart that shows the Federal Reserve's balance sheet, which is contributing to it. And you see these periods that are called quantitative easing, where they're printing money into existence. And you see a big jump during the crash in 2008. You see QE2, quantitative easing round number 2 in 2011 and 2012. And then you see quantitative easing number 3 in 2013 and 14. And then you see in 2018, they were starting to...
quantitative easing is Fed speak. Go ahead and do Fed speak to English. Money printing. There we go. That's quantitative easing.
And then what do you see right before COVID? You see not QE, where they did the same thing. And this is because the reverse repo market started to blow up, but that's a whole nother story.
Yeah.
And then you see this thing called COVID that happened. And we just like flew off a cliff, basically. We entered clown world in financial terms.
Well, and this is a part too, where again, I want to, we had someone give us, I think, one of the greatest compliments that any of our viewers have given us. And they talked about one of the reasons why I love watching you guys is I feel like you really are dedicated to the truth. Here's what I want everyone to understand, because this is the part where some of our audience gets mad at us. Sorry, you got to understand that Republicans and Democrats have both been guilty of this, right?
2008 was under Bush.
2008 was under Bush, and 2021, that was under Trump. Now, again, you can look at COVID, you can look at something that we thought was a potential existential crisis, whatever it is. There was one guy in Congress that stood up and basically said, hey, all this federal spending you're going to do, which is going to require a bunch of money printing in order to sustain, is a bad idea, and I think you should at least have to vote on it. And that was Thomas Massey. Massey, well, yeah, there was
there were two guys in two different eras. If you start with 2008, it was Ron Paul.
Yeah. Thomas Massey got up there, and like Rand Paul was against this as well in 2020. But Thomas Massey got up there, stuck to his guns, said this was a bad idea, and even said this is going to be one of the largest wealth transfers from poor people to wealthy people we have experienced in our lifetime. He was dead on, and he was excoriated by Republicans, by Democrats, by everybody. And I just want to say it right here, because I admire someone that he knew the absolute hell that was going to come down on him for saying, no, if you're going to do this really horrible thing, you should at least have to vote on it, and insisted that they did. And he took hell for it. And quite frankly, I'm very grateful that he was willing to have the guts to do it.
This is the M2 money supply again, just the chart without anything else. And again, what do you see? This massive jump in 2020. And it, by the way, it continued under Biden too. I just want to point out that the quantitative easing, the money printing, 2008, that's Bush. 2020, that's Trump. But you know what? QE2 in 2011, QE3 in 2013, that's Obama.
Yeah.
QE Infinity Part 2 in 2022, 2023, that's Joe Biden.
Yeah.
And so to your point, it is both parties. It's every president.
Inflationary monetary policy has been the most bipartisan thing within the United States government.
So now here's the scary thing, right?
And the reason why I point this out is because this is going to be really important for the next thing that we talk about on how this potentially affects election interference.
Yes. So remember the M2 money supply how this has gone from, $2 trillion in 1989 to, it's like almost 22 trillion today. Well, this number today currently stands at about 20 trillion, right? Take a look at what the national debt is.
Yeah.
Can anybody tell me which of these two numbers is larger than the other?
30, it's over 34 trillion. In fact, it's over halfway to 35 trillion.
So what this means is that there is just the federal government, not states, not other countries, not individuals, not the private sector, right? The federal government has more in debt than there are dollars in existence. You could take every dollar from the M2 money supply, confiscate it from every person in the world, and put it towards paying off the federal debt, and you wouldn't be able to pay it off.
That's insane. Absolutely
insane. So what this basically means is that we're going to there's only one way out, and the only way out is you cannot pay this off, so you print your way into making
it's called monetizing
irrelevant.
the debt, and think of it this way. You owe your mortgage. And so instead of, and you don't have enough money to pay it, but you got to pay it. So what do? You go into your basement and you get out your little money printer and you print out dollars, except that it's legal, right? That's what it is. That's what's happening right now. That is what the federal government is set up for.
Anyone else would get thrown in prison for what the federal government does. One thing that you mentioned is that this is a bipartisan problem. But I would submit to you that even though it's a bipartisan problem, it's almost 100% tied to election years, because they start freaking out that the economy is going to tank, and then they, pressure the Fed to start printing more money. It just happens. But one thing that I wanted to point out is that the difference is that we have people on our side of the aisle who are trying to slam on the brakes on this thing. I don't see anybody on the left trying to slam on the brakes. So there is a penchant for more of that on the left. However, our side is guilty as well, because we have a lot of people that don't care as much about that as they care about the reelection.
No, that's fair. That's fair. Like I will put it this way: when the left prints more money the way that they currently do in it, they're not violating any of their like deeply held, principles when it comes to monetary or fiscal policy. When the right does it, they are violating those principles. So one side is betraying their principles and one side is just living them out, right? And we're getting the same result. And unfortunately, and we have relatively few people, but they have been some good voices. People like Thomas Massey, people like Rand Paul, people like Mike Lee. And there's been some others, and we have some people actually running for Congress now too that actually understand this, like Cameron Hamilton running in the 7th Virginia district actually gets that. Yeah, the problem is fiscal policy, bad fiscal policy. The federal government's desire to spend is fueling bad monetary policy. And we do have some other members of Congress. I don't want to throw everybody under the bus, but yeah, that's
you
a
could
good
probably
point.
count them though on two hands.
The ones that really are willing to do something about it. And again, that's where you get into your Thomas Massey willing to say, this could cost me my election, because he knew both sides were going to come after him, but I'm going to do it anyways because it's the right thing to do and people need to understand what's going to happen. And if nothing more, it's so that 4 years in the future, 5 years in the future, he could come back and say, remember when I said this? And now you're complaining about it. So maybe you shouldn't listen to the people like Elizabeth Warren who voted for all this stuff and wanted it and encouraging it and didn't think we went far enough. Maybe you shouldn't listen to her when she's the one complaining about the results of the policies she actively encouraged. Maybe you should listen to the handful of people that were standing up, screaming, saying this isn't going to work. It's a bad idea.
So speaking of elections and the impact of all of the money printing and the fact that there's more federal debt than there is dollars in existence. Going back to the very beginning of this episode with the headline about how the Federal Reserve basically declared that the war on inflation's over and we're going to start cutting interest rates this year. Anybody who's been paying attention to economics in general knows that the Federal Reserve raised interest rates quite a lot, actually, from what was effectively near zero as late as 2022, all the way up to about 5.25%, just over 5.25%, 5.33% today, which is the highest that it's been in over 20 years, almost 25 years. And at the same time, when you go back to the M2 money supply, you saw that it was dropping. And when you look at the total assets from the Fed's balance sheet, that's also been dropping when they did quantitative tightening, which is the exact opposite of money printing. And in effect, it's money shredding. And so you had for a while, and there's signs that that's coming to an end now, right? Because of this headline about how basically they think that they've won the war on inflation. They're going to start cutting interest rates. So for the last 2 years, they've been shredding money and raising interest rates, which were supposed to be done in order to deal with inflation. But what's really funny is look at the very top of this story here that just popped up. Breaking: Dow surges to more than 450 points. S&P 500 closes at a fresh record high.
Yeah.
So this gets into the election cycle and how this is actually going to be deceiving the American people. And this unfortunately, we're an hour in, but this is the most important part of the episode.
Yeah.
Because what you're seeing is the American people are going to be looking at headlines like that about how the Dow surged to an all-time high, right? And they're going to be like, the economy is recovering, right? You look at hard assets like the NASDAQ, like the S&P 500, like the Dow Jones Industrial Index, and they're all hitting all-time highs. Like here's another one that I had, right, where Dow rises 400 points at the same time that the Fed said that they're going to potentially start cutting rates. And so everybody's seeing that the general things that are supposed to measure the health of the economy, and anybody that pays attention actually knows, though, that the stock market is not the real economy, right? The real economy was shut down during COVID, and the stock market was hitting all-time highs, right? So they're obviously not fully connected. But nonetheless, the layman might look at this and be like, well, Bidenomics is working because the S&P 500 is at an all-time high. The NASDAQ's at an all-time high. Likewise, look at the price of houses. So you see, this is home prices. This is something called the Case-Shiller Index, which it's an index that measures home prices, but this is the raw numbers of home prices. And what you see is, here's like the 2008 bubble, right? Here's the crash. For our audio listeners, you see a steady rise after 2009, and then it gets to 2020, and it goes from being a steady rise to, again, a hockey stick.
Yeah.
And then home prices surged. The median home price went from $322,000 in U.S. currency, this is in the United States, at the very beginning of the pandemic in 2020, to peaking at $479,000.
That's in a 2-year period.
In a 2-year period.
That's nuts.
322 to 479, but it fell a little bit, right?
Yeah.
And that was because of the money tightening, because of the quantitative tightening. So nonetheless, though, with all of the interest rate hikes, with all of the money shredding over the last few years, notice how it didn't collapse all the way back down to where it used to be?
Yeah.
Notice how the stock market is hitting all-time highs, how the S&P 500 and NASDAQ are hitting all-time highs. And by the way, it's not just that. Consider the price of Bitcoin over time.
Yeah.
You see the same thing. As the value of the dollar was going up, now it was still down versus 2019, but in 2022, when dollars were being shredded by the Federal Reserve and interest rates were going up, that actually increases the value of the dollar because you're removing dollars from the system,
Yeah.
which means that there's fewer dollars there, which means the dollars that you have go up in price.
Your purchasing power
and so
increases. as a
other
result.
things in relative to the dollar collapsed in value, like Bitcoin. Bitcoin fell. It peaked in 2021 at the height of the money printing, and then it fell 75%. But now look at it today.
Yep.
It's at an all-time high, or close to an all-time high. It's just off an all-time peak that it set like a couple weeks ago.
Yeah.
And I mean, I just told you at the beginning of the podcast, I bought a whole Bitcoin. I think this is going to go. I genuinely think Bitcoin's going to go to like 1 million over time. And the reason why is because we're talking about prices, right? I just mentioned home prices. I just mentioned the last thing that I'll bring up is the value of gold. This is in dollars over time. You see how gold is almost at an all-time high.
Yep.
Right? So gold is almost at an all-time high. The stock market is almost at an all-time high, or is at an all-time high. The value of Bitcoin is at an all-time high or just off of it. And home prices are at an all-time high or just off of it. So how could all four of arguably the most important hard assets in the entire world be at all-time highs or almost all-time highs after 2 years of money shredding and high interest rates? And how could they be setting new records almost all the time? Well, it's the same type of fallacy that people ask when they go to the grocery store and they say, why are the prices going up? So many people think that inflation is prices going up. It is not prices going up. When you ask why something is expensive, the next question you must ask is expensive compared to what? Because when you start pricing things like the S&P 500 in gold, not US dollars, what you end up seeing is that, well, actually, even though in dollars, the stock market is at an all-time high, it's way off of its peak at the dot-com bubble 25 years ago when it's priced in gold. When it's priced in gold, the S&P 500 is trading at the same price that it was in 1966. It hasn't gone anywhere in 60, 70 years.
And let's keep on what that kind of means here. Like to put this in like a workable example. In 1966, if you were holding $1 worth of gold or a dollar, it would essentially buy the same thing, right? $1 worth of gold or $1 in 1966 would buy the same thing. Fast forward to today, and you got that same dollar and you got that same, what you purchased $1 worth of gold for in 1966. That paper dollar isn't going to buy a fraction of the stuff. But the $1 worth of gold you bought in 66 would buy the exact same amount of goods and service that it did all the way back then. So you would have experienced essentially no difference. Like for you, it's like, well, yeah, the price has remained the same for me from 1966 all the way to today, if you're buying it in gold.
And so the stock market, just like a tomato at the grocery store, can be priced in anything. You could price it in cocoa beans. That's gone through the roof recently. Because again, expensive compared to what? The stock market as a commodity that you can buy is the most valuable ever. It's the most expensive it's ever been. But that's only in dollars. If you were to buy the stock market in gold, it's the same value that it was in 1966, and it's actually below where it was at the height of the dot-com bubble 25 years ago. When you look at housing prices, I just mentioned how home prices today, and if you're a millennial or a Zoomer, you know this, right? Home prices are all-time highs or almost all-time highs, just off of all-time highs, and it's massively more expensive than it was 5 years ago. But you know what? If you're buying a home in gold, it's actually cheaper than it was in 1995 if you were buying a home in gold. And so what this tells you is something that's actually truly terrifying, that we are being bribed by our own federal government into being manipulated into thinking that the economy is booming, when in reality, all that's happening is the prices of everything, including the assets, like the stock market, like real estate, like Bitcoin, like gold. These things are soaring in price, not because the economy is booming, but because the value of your money is disappearing before your very eyes. Because even though it costs you more today than ever before to buy a house in dollars, it actually costs you less money today to buy a house in gold than it did 30 years ago.
Yeah. Well, and
I think it's really important to highlight that, you know, the federal government, I mean, there's a lot of perverse incentives, and I would say that a lot of the misnomers that people have about inflation, thinking that it's just businesses gouging people for money, but they're not paying attention to the fact that it costs a lot more to do business now too. All the prices have gone up, including the price of doing business, including the price of maintaining all these regulations and things like that. And it just, it's sad when I hear this, because I believe that the federal government, the Fed, and the way that they message all of this, the fact that we're not stuck to any kind of gold or anything that's more of a fixed mark, the fact that we don't have that anymore makes it really easy to manipulate the public. And most people, you've got some people that are really business minded and they understand what's going on and they're not deceived. But that's not a vast majority of the people. A vast majority of the people are just trying to make ends meet, living their life. They're not diving into monetary policy and understanding actually how this is working. They just think that the employers are terrible employees. It's kind of like this tip culture we have now, where every single time you turn around for anything at all, they flip that little screen around. Oh, one more question here, and they just watch you to see if you're going to add a tip to whatever it is. And I mean, they do that. You go and get your own food and you go to the kiosk and pay for it, and it still asks if you want to tip the people. It's amazing. But people are getting the wrong message from this. They're going, well, these employers should just pay their employees what they're worth. Why should I have to cover what the employer should be paying? And that's not the case at all. The idea is it's a lot more expensive to employ these people. Well, and so I feel like the federal government really relies on the ignorance of the populace in order to pull the wool over our eyes. Because if the vast majority of the people understood what was going on, they'd never get away with this. They'd never get away with the way that they're packaging this and doing this if people really were clued in. But it's just this big manipulation and money schemes that at the people's expense.
Well, and I think, and that's where, again, to the point you brought up earlier on, there's been a lot of times that, again, politics has influenced the money supply, because it's ultimately run by politics. And then obviously that becomes that much more important during an election year. And again, politicians of both parties engage in it because it's the easiest way to get a couple of metrics that make it appear as if everything is going fine. And so what are we going to see? What are we going to see leading up to November? Well, you're probably going to see more reports of the stock market soaring. You're going to see housing prices, going up and more housing purchases. Now you might ask yourself, well, houses are getting more expensive. Why would people buy them? Well, if you can qualify for a bigger loan, right? If you can qualify for a bigger loan because interest rates went down a little bit and it's easier for banks to be able to cover those loans, well, then you're going to take the chance because one thing is that whatever you bought the house at, the price is going to go up. It's only going to get worse. So you got to get in now. We got a little dip in the interest rates. Get in there now, and you're going to be fed this narrative.
Smart money is protecting itself from what it believes will be a return to inflation in the same style as the 1970s, where we went through cycles of inflation. And like one last example that I just brought up, because it just dawned on me, is here's the Caracas Stock Exchange in Venezuela.
Yeah.
Look at this number. You would see, looking at this, that, whoa, Venezuela like discovered faster than light travel and is now, living in a utopian golden age where everybody, a post-scarcity society, because look at how rich they are.
Yeah.
Well, no, it's not because they're rich at all. It's because they printed their money into infinity. And so the stock market went through the roof. Like, you want to know that the number one performing stock market in the world over the last 4 years? The Zimbabwe Stock Exchange.
Yeah.
I'm not even kidding you. And so, again, is this because Zimbabwe has become a first world country that is an economic superpower? No, it's because the value of their money disappeared. And so hard assets, fixed assets like stocks, like real estate, like gold, like Bitcoin, those things, when measured in the currency of that country, have skyrocketed. Not because they're making more stuff or they're actually richer, but because the money that was used to buy those things, well, that increased 1,000-fold, but the amount of gold in existence or Bitcoin in existence hasn't really increased 1,000-fold at all in that time period. So again, we're not going through what Venezuela went through, at least yet.
Yeah.
But when it comes to election meddling, what's so disingenuous about this is that Biden is going to spend the next, 7 months or so campaigning around the country saying Bidenomics has worked. Look at the stock market. And in reality, the reason the stock market's doing so well is not because we're in some golden era of productivity. The reason the stock market's doing so well is because your money is worth less. It can buy less of the stock market, just like it can buy less at the grocery store than it did 5 years ago. That's the reason he's going to go around and try to get elected on the booming economy, when in reality, we're being bribed with our own money at the expense of inflation. It's like how we were all given $1,000 stimulus checks. They bribed us with stimulus checks and we got the inflation, and the politically connected elites in this country got the actual value of the money, which is why you're seeing this explosion in income inequality between the ultra wealthy that I showed earlier and the average Joe out there. It's not that all the ultra wealthy are evil bad guys. It's just simply that smart money is doing the necessary things to protect itself from the inflationary monetary policy.
And that's the point. That's the point that has to be reiterated over and over and over again. It's like, okay, let's say you're a wonderful, good middle-class person, but tomorrow you're a billionaire. And someone comes in and tells you, hey, the federal government is about to do this, so you better move all of your assets over here. Are you going to say, no, I refuse because no, you're going to move your assets because why wouldn't you? Of course you're going to do that. Now, are you a bad guy because you knew how to move your assets in order to protect yourself from stupid decisions? No, you're not. The problem is that most people either don't have the time or the knowledge that such stupid decisions are being made. And even if they did have the time and the knowledge, they don't have assets to move. And you're creating conditions where do people move those assets when they move it into something that's hard and real? So they'll move it into housing. There's a reason why BlackRock will buy up as much property with inflationary dollars as possible. Because if it got that inflationary dollar first before you did, and they go out and they buy a bunch of property at the current rates, them buying the property with those inflated dollars is what's causing the property to go up. So now when you go to try to buy it with a devalued dollar, it doesn't go as far. But they got the full value out of it. And this is the part that's so frustrating, is that, again, the progressive politicians that are just so concerned about the working person, really? Then why are you doing the things that only seem to benefit the people that are responding to your behaviors? And then they want to turn around and say, that's okay, we'll make it better with a wealth tax. We'll make it better with a minimum wage increase. Oh, okay, so now you want to make it illegal to hire me for anything under $15 an hour, and that made my life better? You want to make, so let me get this straight. You want to tell someone that has their money currently invested in a company which is employing thousands of people that, hey, we're going to tax you in such a way to where you have to sell the assets that make it possible to hire the people in order to pay the government money so that we can hand it out in the form of government subsidies. That's going to be helpful? No, it's helpful to one class of people, Politicians. That's who it's helpful for, because ultimately they put themselves in a position where they get to decide who has money and who doesn't, who has access and who doesn't. And I can tell you this much, I've seen a lot of people that are so very good at telling people that they really care about you, when what they really care is about keeping you in a position where you're dependent upon them because they think you're too stupid or too lazy to be able to figure it out for yourself.
Elizabeth Warren.
Well, wait a
thinks
second,
that-
Tina.
Oh, I'm sorry. Can I mention one thing? Just, you touched a little bit, Christian, at the beginning of this, about this idea of election interference through the Fed. And I actually think it's a little bit more nefarious than that. So the premise is that the Fed starts responding and trying to make it look like the economy is doing well, so that their guy can get in. And obviously a lot of them are left leaning, so they want the Democrats in office, right? My thought is this: they know that a crash is coming. They know that there's going to be a sovereign debt crisis at some point. They just don't want it to happen on their watch. And so the fact that that beefing up the messaging right now and trying to manipulate everyone right now and trying to show these big arcs and everything else right now is actually not necessarily just to get Biden elected. I think they've seen the writing on the wall. They know Biden's never going to get reelected because look at him. The guy doesn't even know where he's at. So they know Biden's not going to get elected. So what are they doing? They're trying to beef it up so that whoever takes over on the other side gets the crash on their watch so that they can swoop in. They play the long game all the time. So you've got a situation now where we're going to go ahead and crash this economy on somebody else's watch. And we're going to be like, see, don't you wish we were in charge? And because it's going to happen no matter what at this point. And they're right now doing more to hurt it. They're going backwards, from, it looked like they were going to try to fix it a little bit. And now they're totally going backwards. And I feel like they're trying to run it off the cliff and hope that it dives on like Trump's next watch so that they can, on the other side, get whoever they raise up elected. So I do agree with the election interference idea, but I think they're trying to interfere with the next election, not necessarily this one.
So Tina brought up something interesting. She's talking about like a crash falling off a cliff. There's two different types of crashes. One's you're falling off a cliff, and the other one is you're ejected into outer space. And what I mean by that is that there's a deflationary crash and there's an inflationary crash. For a while, it was looking like we were going to see a deflationary crash when the Fed kept raising interest rates and shredding money. But now that they're stopping those things, what you're going to see instead is we will all become billionaires. The Federal Reserve will guarantee eventually that every American will become a billionaire. It's just that
we'll all be hungry.
We'll all be hungry. And the last thing I want to bring up when it comes to how nefarious this is and why certain assets like housing will go up even faster than the money printing is an analogy that actually Pierre Poilievre came up with in Canada. Pierre Poilievre is the head of the Conservative Party in Canada. He's a super base guy. I highly recommend you check him out. He knows his economics. And he gave a speech on the floor of the Canadian Parliament, I believe it was last year, might have been 2 years ago. But he said, here's what's going on with the housing market, because Canada has the same problem that we have. In fact, it's actually magnified even larger. When the government prints the money and then injects it into the banking sector, because that's usually where it first ends up in. And then those banks go out there, and not just the banks, the financial system in general, stock markets, individual investors, anybody that gets their hands on the money. When they go out there and they buy hard assets, I'm going to use a house as an example, but you could actually apply it to almost anything, but housing is the most nefarious of this. You go into the market and you go into a neighborhood where hypothetically, let's say every house is priced at $100,000. Nowadays, it wouldn't, but just for the sake of the argument, every house is priced at $100,000. You outbid the other person that would have bought it at $100,000, and let's say you put in $200,000. So now you have bought the house with $100,000 extra inflated dollars that came out of nowhere. You bought the house. But guess what? The way the housing market works is every house is priced based on other houses nearby. So if somebody has bought one house in the neighborhood with $100,000 more dollars than the original asking price with inflated money, so the money supply is increased by $100,000, and you bought the house for $200,000, well, now every house on the block is going to be worth $200,000 because the latest house on the block was just bought for $200,000. So for an increase in inflation by $100,000, You've now turned a block of 10 houses, you've increased it by $1 million because the price of all the homes have now gone up 100,000 times 10 is $1 million. So for the cost of inflating the currency by only 100,000, you've now increased the housing market by $1 million. And so what you end up seeing is this, again, hockey stick effect, which is why nobody under the age of 35 can afford a home in Canada and arguably never will be able to afford a home. In fact, there was a government report that came out like a few weeks ago from the government of Canada, the Mounties, that were, and most of it's redacted, but parts of it weren't, where they were warning the Prime Minister that Canadians might revolt against their own government once they realize A, how poor they've become, and B, that they will never be able to own a house and they've been turned into 21st century serfs. The same thing that's happened in Canada, and they're way further ahead of it than we are, is the same thing that's happening here. Remember what I said? The Federal Reserve is going to turn us all into billionaires. You just won't be able to buy anything because the houses will be in the trillions. Now, I might be exaggerating the numbers here, but the effect is still the same.
You know, we did a whole video on that, just to kind of sum up all of this. We did a whole video on this once talking about the situation in Zimbabwe where literally people would go into a grocery store with a wheelbarrow full of money and not be able to buy much of anything. And in fact, when they pulled something off the shelf, by the time they got to the checkout, the price had already increased again. That's how bad it can get. The other thing that I want people to understand is that when this happens, right, because it's going to happen. This sort of stuff is already happening in places like Canada. It's been happening in the United States, but it is going to potentially get worse based off of what they're doing. And the problem is the same politicians that have created the conditions to make it worse, the same politicians that created the conditions where, yes, you have a wealthy sector of the population that are able to navigate inflationary monetary policy better than anybody else. They're then going to point to them and say, see, capitalism. See, wealth, income, inequality. That's what this is. And the solution is going to be politicians like them that will make sure that we have greater equity within society through greater central planning of the economy and redistribution of wealth. And what you need to understand is they're already redistributing wealth. They're redistributing it away from you and to people that understand how inflationary monetary policy works. They're already doing it. But they're doing it at the same time that they're claiming to be on your side. And that's the problem. Capitalism, free market economics, private property rights, that is not what got us into this place. The free market doesn't create this sort of monetary policy. Governments do. The free market doesn't create the Federal Reserve System. Governments do. The free market doesn't create a lot of what we're seeing today. But you know who does? The government. And usually it's the same politicians telling you that the free market or capitalism is the problem. It's the same people telling you that the real concern about income inequality is the threat that it poses to democracy. You know what? If they were so concerned about genuine freedom in this country, they would stop engaging in the sort of fiscal and monetary policy that they are. But they're not. And so you got to ask the question, why is it? And they are gift wrapping a villain for you. Not because there aren't people that do behave in a way that is fraudulent or wrong or inappropriate. But I'll tell you this much. If you're the sort of person that has that kind of money, why wouldn't you move it into the sort of assets that will actually make you wealthier during inflationary monetary policy? You don't control the Fed. You don't control the United States Treasury. You don't get to vote on the United States budget. But Elizabeth Warren does. So is she adjusting her behaviors and her voting patterns in order to correspond with the problems that we've articulated here today? Nope, she isn't. She's doubling down on every single piece of it. And so you got to ask yourself the question. It turns out that the best case scenario is that the Fed is engaging in this sort of activity because they do want a slightly stronger economy going into all of this so that Biden can run around talking about what a great job he's done. The far worse scenario is the one that Tina mentioned, where all of a sudden we find ourselves in a situation where they know it's going to crash. They know there's going to be problems, and they just don't want it to happen on their watch. Because again, if they've gift wrapped a villain for you, and the villain is capitalism, the villain is the evil business owner, well then voters are going to show up en masse in order to vote in the sort of politicians that are going to punish those people. And the end result is they're going to end up with a far worse situation, and that is with the same arrogant politicians who created this scenario, who created these problems, now exacerbating them, making them worse by diminishing your ability to actually choose what you do with your labor, choose what you do with your property, choose what you do with your dollars. Because they are going to constrict it like you would not believe based off of regulations, taxes, fees, fines. And the only people that are going to get over in the sort of scenario that they're running are the ones that are connected to them or the ones that they think will realistically vote for them every time because they're absolutely dependent upon the government for their very existence. But for those of us that actually believe in the sort of environment, the sort of upward economic mobility that the United States used to offer because it was a freer economy, not a more controlled one, we're the ones that are going to be in a bad situation. So I will tell you this much. Please, please, please understand what is going on, properly diagnose the problem so that we can actually elect people like Thomas Massey that will stand up when this is taking place and saying, no, not on my watch. This is wrong. I know what you're doing. I see what you're doing, and I'm going to expose what you're doing so that people can make a better and more informed decision. The other thing, too, is understand this. We can't always affect what the government does to the economy, but we can be smart about what's going to happen, and we can adequately prepare for it within our own financial lives. The other thing I will say is there's a lot of speculation going on. That's what you're seeing in the stock market right now. You're not seeing stock market prices go up because of drastically increased productivity throughout the country. We haven't unlocked new magical efficiencies or productivity, which is causing the sudden spike. This is monetary policy. This is inflationary monetary policy and arbitrary, interest rate tampering. That's what's going on. So the question that you're going to have to ask yourself is, as we go through this, you're going to be subject to some of it, whether you like it or not. So how do you put yourself in a better position with the sort of skills that you possess, with the sort of people that you know, with the sort of network that you have? It is becoming more and more important for a variety of reasons to be able to know your people, know who you can work with, know who you can trade with, know who you can engage in commerce with. Because unfortunately, we seem to have a federal government that is absolutely hell-bent on making us poorer in order to justify their own power. Sorry to end on somewhat of a dire note, but I will say this as my white pill moment at the end of all of it. I honestly do believe that more and more people are waking up to this. More and more people are waking up to the problem. And even if they don't understand all the intricacies of sound money or monetary policy or fiscal policy or what these politicians are doing, they're able to see through that which makes sense and that which doesn't. And a lot of things that are going on that we've been told that we should just believe because the experts say so, or because all the top economists say this, or because all of the great government officials or this particular agency said that. More and more people are saying, yeah, I don't buy it. It's not that I'm not willing to trust somebody with genuine expertise to be able to provide insight, but I'm no longer willing to blindly follow a government agency or an expert whose entire existence is there to essentially validate whatever the government has told them to say. I'm no longer willing to buy what they say just because they said it. I'm going to actually do my own research, and I'm actually going to set up for my own resiliency because you have proven that we can't trust you. And quite frankly, the more Americans that choose to do that, not simply as a stopgap for the worst that could possibly happen, but the more Americans that try to take more control over their own financial future, over their own capabilities, over their own networks of friends and people that they do business with, the more that happens, the better off. Whether or not things get better or whether or not things get bad, the more you focus on the things that you can control within your own life, while not ignoring politics, but not being consumed by it, the better off you will be, your family will be, your community will be, and eventually your country will be. So don't ever think you're powerless in this process. You might not be able to affect what the Fed does, but you can look at what they're doing, be a little bit wiser about it, and make decisions that are going to be better for you and your family and your community. Once again, thank you very much for joining us. We hope this was helpful. We hope we've done a good job of properly diagnosing the problems with these recent Fed decisions, as well as all of the decisions that have informed so much of what the Fed and the federal government have decided to do. Because again, ultimately, with that knowledge, armed with that knowledge, we'll all be able to make better decisions and turn the ship around. Thank you very much for joining us, and we'll see you next episode.